After years in investment banking and asset management, certain patterns become difficult to ignore. One of them concerns the middle class, not its struggles, which are well documented, but its structural contraction. In 1971, middle-income households represented 61% of the American population. That figure has since fallen to approximately 50%. The economic forces behind that decline are not cyclical, they are structural. The distinction between households that have maintained financial stability through this period and those that have not comes down to a small number of economic decisions. Decisions that are identifiable, repeatable, and available to households across most income levels. This video examines what those decisions are, why they work, and what is driving the broader contraction of the middle class. The post-war middle class was built on a specific economic model. Stable employment, home ownership, and incremental savings were sufficient for several decades to sustain a reasonable standard of living and modest wealth accumulation. That model began to break down in the early 1980s. Between 1979 and 2020, productivity and wages, which had historically tracked closely, decoupled. Output per worker continued to rise. Median wages did not keep pace. Over that same period, top-income households saw earnings grow by more than 160%. The bottom 90% saw growth of approximately 26%. The difference was absorbed primarily by rising costs in three categories: housing, healthcare, and higher education. The same categories the middle class had long relied on, for stability and upward mobility. The median American household today earns approximately $74,000 annually. After taxes, housing, transportation, insurance, groceries, and childcare, the average family retains less than $500 per month. That margin provides little capacity to absorb economic shocks, accumulate assets, or generate the compounding returns that sustain long-term financial stability. The Federal Consumer Price Index, the primary measure of inflation, consistently underweights the goods and services most consequential to middle-income households. When housing, healthcare, and education costs are weighted more accurately, effective inflation for middle-class families has tracked considerably higher than official figures suggest. In some analyses, running closer to 7 or 8% annually over the past decade. Against that backdrop, savings accounts yielding less than 1% represent a net loss in real purchasing power over time. Three structural forces are driving this contraction. The first is the inflation differential described above, the gap between what official measures report and what middle-income households actually experience in their cost of living. The second is wage compression, driven by technological displacement. Middle-skill, middle-income occupations are being restructured at an accelerating pace, not only in manufacturing, but in accounting, legal research, financial analysis, and administrative functions. The income gap between workers with adaptive, high-demand skills and those without is widening steadily, and is projected to accelerate as automation capabilities expand. The third force is more fundamental. The economic rules governing wealth accumulation were substantially revised over the past 4 decades, and that revision was not widely communicated to wage-dependent households. Wealth at scale is not built primarily through earned income. It is built through the ownership of income-producing assets, real estate, equities, businesses that generate returns independently of the owner's labor. This principle is well understood among institutional investors and high net worth individuals. The distinction between households that act on it and those that do not is the primary driver of the growing divergence between income groups. A salary is, by design, capped by what an employer is willing to pay. The income generated by assets, rental properties, dividend-paying equities, equity appreciation, operates under no equivalent constraint. Middle-class financial strategy has historically been organized around earned income. The households that have moved out of the middle class, upward, have generally done so by shifting toward asset ownership and the income streams it produces. There are concrete examples of this transition occurring across ordinary income levels. In 2009, a postal worker in Memphis, Tennessee, used $18,000 in personal savings to purchase a foreclosed duplex for $34,000. The property generated $800 per month in net cash flow from the outset. He acquired a second property 2 years later, then a third. By 2019, he held 7 units, generating $6,200 per month in rental income and retired from the Postal Service at 54. He held no finance degree and had no inherited wealth. A teacher in Atlanta began contributing $200 per month to an S&P 500 index fund in the early 2000s on an annual salary of $38,000. She increased her contribution proportionally with each raise and maintained the strategy without interruption. By 2023, her portfolio had reached approximately $680,000. The outcome was not a product of market timing or stock selection. It was the result of consistent, long-duration participation in a compounding asset. A dual-income household in their early 30s, with a combined income of approximately $95,000, identified that their financial position, despite adequate earnings, provided no buffer against a single disruption. They held no meaningful assets. Over 6 months, they reduced discretionary spending by roughly 30%, retired high-interest debt, and built a modest liquidity reserve. They then acquired a residential rental property using an FHA loan at 3.5% down. That property currently generates $1,100 per month in positive cash flow, and a second acquisition is under contract. Their income did not change. Their allocation of existing income did. Several financial behaviors consistently distinguish households that build durable financial stability from those that do not. The first is tracking net worth rather than income. Net worth, total assets minus total liabilities, is the more accurate measure of financial position. A household earning $120,000 annually but holding no appreciating assets is structurally weaker than one earning $70,000 with $200,000 in productive assets. Establishing a clear baseline is a necessary precondition for improving it. The second is maintaining a consistent savings rate. The amount saved is a function of income. The rate is a function of discipline. Households that sustain savings rates of 20% or higher across varying income levels generate the capital necessary to acquire assets. The savings rate is more predictive of long-term financial outcomes than income level alone. The third is transitioning from saving to deploying capital. A savings account earning less than 1% annually does not function as a wealth-building instrument in an inflationary environment. Capital must be directed into assets generating returns that exceed inflation. The specific vehicle, real estate index funds, a cash-flowing business, is secondary to the decision to deploy rather than hold. Inaction carries a real cost that is consistently underestimated. The fourth is building income diversification. A household whose income depends entirely on continued employment holds no buffer against labor market disruption. A single additional income stream, one that operates independently of the primary earner's direct labor, materially reduces that exposure. The objective is not the elimination of earned income, but the reduction of dependence on it as the sole financial foundation. The fifth is maintaining a sufficiently long investment horizon. The individuals described here did not build financial stability quickly. The Memphis postal worker operated over a decade. The Atlanta teacher's portfolio accumulated over more than 20 years. Those outcomes were not exceptional. They were the predictable result of sustained, consistent behavior applied over time. Short horizon thinking, reinforced by high visibility, rapid gain narratives, is one of the most reliable obstacles to ordinary wealth accumulation. The contraction of the middle class reflects 4 decades of structural economic change. The decoupling of wages from productivity, the rising real cost of essential goods, and the increasing concentration of asset ownership in upper-income households. The households that have maintained or improved their economic position through this period share a common characteristic. They transitioned, at some point and to some degree, from a financial model built on earning to one built on owning. That transition does not require exceptional income, inherited wealth, or specialized knowledge. It requires a clear understanding of the economics at work and a consistent set of decisions applied over time. The economic trajectory described in this video is well documented. The steps available to address it at the household level are equally well documented. The variable is whether those steps are taken.